And we said, we're looking at everything under the sun, and Bitcoin was one of the things. So my first love of the Bitcoin community was, the way that I knew I liked all the Bitcoiners was one day later, some cyber hornet, some Bitcoiner goes, MicroStrategy is considering buying Bitcoin with $250 million. Now, as Bitcoin merged in there with gold, silver, commodities, equity, property, real estate, anything you could have imagined. But the Bitcoin community immediately picked up on that. I don't know how they do that, right? They must be scanning for this. Nobody else picked up on it. The stock was trading $120 a share. A week goes by. Literally, you announce you're going to spend $250 million and buy your stock back. You think it would move? Nope. Crickets. But the market had a week of notice. And then a week later, we stepped it up into the next gear, which is, okay, we're going to buy $250 million worth of Bitcoin. We made the decision. We're not splitting it across 6 assets, right? And it's a good thing we did, right? Because Bitcoin's up 332% in 12 months. Gold is down 7%. If we'd split it 50-50, 125 million of gold, 125 million of Bitcoin, right? It would have cost us billions. If we'd gone all gold, it would have cost us many, many, many billions. We'll come back to that in a second. So we had to do something, but the question is what? So we just picked Bitcoin. We made the decision, but we thought, this is going to be jarring for some people. Stock is around 122 at the time, right? To put this in perspective, the company's $500 million revenue generator, generating cash flow, and we have more than 500 million in cash and about 10 million shares. So the company's trading at 1 times revenue plus cash. Mm-hmm. We give back all the cash, the company trades at 1 times revenue, the stock goes to $60 a share. Right? So we're like 122, no one's really paying attention, but we said, well, maybe people think this is offensive, they're not going to like this, or it's too risky. How do you actually orange pill every one of your outside shareholders at the same time? Well, you can't. So the next best thing is we just offered to buy them out. So the idea is if you don't like this, we're going to buy you out. We're going to post $250 million to buy back shares at a premium. So we offered to do the buyback at up to $140 a share, which is, buyout premium. If you don't like it, then you sell your shares back to us at a profit. We wait 20 days. So the market trades for 20 days, and in the first week, the market's trading on 135. Like people, so they're not even quite sure about the buyout. Then after a while, they start thinking, they're like, well, if I can put it back to the company at 140, then presumably maybe it's worth more. So the stock trades up a bit past the 140. And at the end of the tender period, we have about $60 million worth of shares tendered. Everyone that didn't like the strategy had 20 days to sell into the open market. And if you sold in the open market above 140, then why wouldn't you? And if you're still holding the shares at the end of the tender period and you don't like the strategy, you sell into the tender. So the result of the Dutch auction is we had $175 million of extra capital. We thought about it. We put out another press release. Okay, this is our primary treasury reserve asset. So the first notch was, this is a treasury reserve asset. The second step is, this is the primary treasury reserve asset. Then we bought 175 million more Bitcoin. So at that point, we're up to 425 million. The first tranche is in the 11,500 range. That was a little bit difficult. It was more difficult to do the second tranche because Bitcoin traded down. We had a loss. It traded down to into the tens and even, you remember that. So the second tranche we bought at 10,000 something because we're committed, right? And if you go pull the Twitter stream, there's all sorts of interesting commentary on our strategy.
So you basically had done, let's call it up to that point, 425 million of a $500 million balance sheet. And you had rotated your shareholder base to people who were aligned with the strategy. And you had also planted the flag in the ground as the first publicly traded business in the United States to identify a treasury strategy that would leverage Bitcoin as the primary currency or the primary asset that you would use in your treasury. When you do all that, I know that there's been a whole bunch of conversations in the behind the curtain. I don't need names, but what are other fellow publicly traded companies, other finance executives, people on Wall Street at that point? Are they saying you're crazy? Are they, oh wait, this is really interesting, tell me more about it, trying to learn? Like, what was the reaction after the first $425 million?
I think it was largely ignored by every other publicly traded company. I don't think there's a lot of awareness or to it. When we did our due diligence checks, we found Overstock 2 or 3 years ago had a few $1 million of Bitcoin on his balance sheet. And that's it, right? We couldn't find anybody else. And so this is off the beaten path, but it seemed like so rational to me. Like, it seems so obvious. Bitcoin is digital gold. It's basically engineered to be digital gold. What do you need in a inflationary environment? You need something that's like gold, but better than gold. You have to make a choice. It was obvious that the institutions were coming, right? I mean, you had companies like Fidelity getting into this space just 6 months earlier or whatever. But the fact that we're institutional custodians was a big checkbox. Grayscale was doing good business at that time. So it struck me as being a rational thing to do, but no other public companies had done it. And it wasn't totally clear to me why, although at this point now it becomes clear, right, in hindsight. So we went through that. We did the 425 million. The stock traded up. Bitcoin started trading up. At that point, I started speaking in public, and you were the first person I spoke to.
I remember,
right? and I learned most of what I knew about Bitcoin by scouring the internet and looking at your podcast and reading all of the stuff that was posted, right? And I tripped through all these different things. And one thing I knew from your podcast was you always ask a question, right? At the end, right? You're like, you can ask me a question, remember?
Correct.
Now you get to ask me the one question. So what I remembered about Pomp was he wants to know a book and he wants a question, or he gives me a question. So I'm like, gosh, what question am I going to ask Pomp? And, how do you learn Bitcoin? You study Twitter and you study YouTube and you surf the web. So here's what I know. I know I get to ask you a question, and I know Jack Dorsey has Bitcoin in his bio. So the question is, how do we get Jack Dorsey to buy Bitcoin next?
Correct.
Right?
Correct.
And, at that point, we're all alone as a publicly traded company, and people aren't quite sure if we're crazy, but what happens next is some bullish things, right? I mean, I thought that when Square bought Bitcoin, that was a seminal event, right? Because one data point is a question mark, but when you had the second data point, you can draw a line. And so that was a big day. When PayPal announced support for Bitcoin and they started moving it, that was a big day. That was a data point, right? Those were the data points that moved us from 10,000 to 12,000 a coin. And at some point, some Citron research studied, discovered my stock, and Andrew left, I guess, said something positive, and the stock started trading up, and then it traded into the high 100s, and then it traded into the 200s, and Bitcoin started trading up, and when we got into the teens, people thought, oh, well, there's something interesting here. So the next step in our journey was, like, in addition to me starting to communicate why we had done what we'd done, the next step in the journey was to go out and buy more Bitcoin. So we started buying more Bitcoin as part of the Treasury Reserve strategy, and that got people's attention. Then when the stock got to the 300 range, that was the highest it had been in a decade, 300. So we started thinking, well, maybe we can raise more money. And so we went back to the convert market, and we were trying to raise $400 million in a convertible debt offering, but it was extremely popular and we were oversubscribed. So we upsized the deal to $650 million. So that was a screaming home run. We we had proposed a 32 to 37% premium. We priced it at the 37.5% premium, the high end of the spread. We'd proposed like 1.25% to 0.75% interest. We priced at the low end of the interest rate. So we raised $650 million at 75 basis points with a strike price of $398. The stock had not traded at $398 in a decade. So it seemed like reasonable. If you could sell $650 million of stock at $398 a share, it seemed like a reasonable thing to do at the time. So then we took that and we bought Bitcoin with that. So that was, we started out with we're going to raise the money for general corporate purposes. And along the way, the discussion was, what are you going to do with it? And I said, well, I want to be able to buy Bitcoin with it. And they said, well, we should put that, into the disclosure. I said, yeah, we should disclose that. And then they said, well, are you sure you're going to buy it? And I said, yeah. So eventually it flipped and it became, we're doing it to buy the Bitcoin. So that became, in the history of first, right? We're the first public company to buy Bitcoin on the balance sheet. We're the first public company to declare it a Treasury Reserve asset. We became the first public company to do a Dutch auction, which is in essence like an equity issuance to buy Bitcoin, right? It's like I'm either buying my equity back or I'm or issuing the equity. So the first Dutch auction, where the proceeds eventually became Bitcoin. Then the first convertible bond to buy Bitcoin. And I think that all of those things rotated the shareholder base, right? I think the most important thing was to be long Bitcoin, right? So in essence, the first publicly traded company where the shareholder base is long Bitcoin. And it started out, my aspiration was, it'd be great if half of our enterprise value is based upon enterprise software and half is based upon the assets. Because before we did this, we got substantially no credit for the assets. Like people were basically taking the 500 million and they're like, okay, well, that's going to be worth zero, right? Or negative.
Because you were 1 times revenue plus just the cash on the balance sheet.
Yeah. Yeah. So if you've got a low growth cash cow, right, that's like being a dentist where you're going to make a lot of money every year for a decade and maybe you'll make 5% more each year for a decade. If you've got a low growth cash cow, but the money supply is debasing at 25% a year.
Kills you.
Right? It's like the road to serfdom is working exponentially harder for a currency getting exponentially weaker. What I saw was 2,000 people doing 100,000 things right every year to make $50 million and then watching the enterprise lose $100 million a year due to a political decision. So in essence, we're running as hard as we can. We're falling backwards. And the situation was literally hopeless, right? Like people wonder, where did the Bitcoinist hope come from? Well, it just was hopeless, right? I mean, the operating business is hopeless and okay, you're going to work yourself to death for a decade and do 1 million things right with 2,000 people, and you're going to be worse off in a decade than you are today. Okay, that's operationally hopeless, right? And then on the balance sheet, if somebody says we're not even thinking about raising interest rates, it means for the next 4 years you're going to get 0% on your money and is going to be worth half as much in 36 months as it is worth today. And the balance sheet is hopeless.
And this is all before we even see the persistently high inflation that we're seeing now, right? This was just from a market structure standpoint of this had been going on pre-COVID, got accelerated during COVID. You started to recognize this again. Last year, if you go back and you look at the inflation numbers in Q3, Q4, I mean, it was obvious that we were increasing or accelerating, but we weren't at 5% CPI for 3, 4, 5 months, right? Now is a much, much different situation. So at what point do you switch from this as purely a defensive like treasury strategy of we want to take the cash on our balance sheet and put it in an asset that we can protect ourselves, protect our purchasing power, to then it feels like you made the switch to go offensive. That first bond offering was an offensive move.
I think you called it right there. I think that it's a defensive strategy through the Dutch auction. We had to do the Dutch auction to provide a graceful transition for our shareholders to get long Bitcoin, right? You're either long Bitcoin or you're selling out to us at a premium, one or the other. And then from that point, Bitcoin started moving up and our stocks started moving up. And then we realized that like the conservative thing to do is just stop there. And if we'd stopped there, I mean, we would be all equity, $475 million invested at $11,000 a coin or something. And that's not a bad result, right? We would have made 6x our money. But what we realized is we could borrow money at 75 basis points. And Bitcoin's up 171% a year every year for a decade, right? If you can borrow money at 1% and invest it at 171%, your arbitrage is 170% on how much? Well, how much do you want, right? Like, where are you going to stop that?
When you borrowed at the 75 basis points, I was impressed. But then you followed it up and you borrowed even more at a 0% interest rate, if I remember correctly. What was the second offering?
Because the first offering came out, the strike was 398. Bitcoin kept moving up. Our stock kept moving up. Eventually, that bond was the best performing bond of the entire year. Right, Anthony? What I'm saying is of every single corporate bond sold in the year 2020, every convert, every junk bond, everything sold, every municipal bond, whatever you could imagine, the single best performing bond was MicroStrategy convertible bond, where you could have doubled your money. At some point it was trading insane amounts, like triple, your money on a bond. Okay, so we had good success there, and of course Bitcoin kept moving up, and our stock kept moving up, and we realized by February that we could do another offering. The next offering was we came in the market offering $600 million. The first one we started with $400 million. This time we started with $600 million. But again, it was oversubscribed. We upsized it, exercised the green shoe. It became a $1,050 million offering. And the range was 50 basis points to zero. So we struck it at zero. And up 50, 37, I forget the number, but we ended up having a 50% premium or 47%. I forget exactly. It was a high premium. It was a low coupon. The strike price was $1,432 a share. So now put this in perspective. This is 10 times the price of the Dutch auction, some number of months earlier. Now, so why'd we do that? Well, because if you could borrow $1 billion at 0% interest and invest it in something going up 170% a year,
pretty good trade.
Why wouldn't you do it, right? Like every single business on earth that's debt financed presumably is borrowing money to invest in something which is going to return a higher yield than the cost of the debt. Now, I want to pause here and make one point. The reason that I was sensitive to inflation was I immediately saw the inflation in March and April in the stock market, right? Because my inflation bogey wasn't, if I were to go to all my investors and say, I got $500 million, I'm investing it at 2% interest and inflation rate's 1%, they wouldn't have given me a pat on the back. They would have said, the S&P index is moving up 10% a year. Your hurdle rate, your cost of capital is not 1% or 2%, it's 10%. And maybe you're getting 5% yield on a piece of debt, then I don't hold my nose, but you're losing 5% a year. Half-life of the money is 12 years. Okay, fine, but like you shouldn't be holding it. You should be buying your stock back or buying another company with that. Sitting on that cash it doesn't make any sense. Saifedean says the dollar-weighted monetary inflation rate across all currencies for the last 30 years is 14%. Interesting number he comes up with. 14% is the inflation rate of the currencies. Now, that would be the inflation rate on scarce desirable assets or any portfolio of assets. And if I look at my screen right now, over the last 10 years, the S&P 500 is showing 14.15% interest, or 14.15% compounded annual growth rate. NASDAQ's up, 19%, gold is up 20 basis points, nothing. Bitcoin's up 170%, right? And long bonds give you like 2.5%. So the monetary inflation rate equals the S&P index. Well, the traditional way you'd value a stock is you would put a risk premium on it, and you would say, well, your cost of capital is the return plus the risk premium. So it used to be we'd think, well, there's a 3% risk premium, and the inflation rate then would be 11%. But I think that if you buy the S&P index, you're kind of in theory stripping out the risk because you're buying 500 companies. So the S&P index can be viewed as a proxy for monetary inflation. And the question of inflation is, what's your inflation rate? Well, what do you need to buy? If you're a consumer, then your inflation rate might be CPI if you agree to buy what the Federal Reserve tells you you should want, right? And the market basket of things in the CPI is what the government says you should want in your life. But they never included a Picasso or a jet or a yacht or a house in Miami Beach in that market basket.
A step even further than that is the number 14% is very interesting, because my understanding is if you go back, obviously CPI used to represent a cost of goods index. So what is literally the change of price of individual goods year over year over year, and that's how inflation was measured. Now, obviously, we have a cost of living index, which is what you're talking about in terms of, well, here's the things that we think you should want. Here's the general weightings of these specific assets or consumables inside of this basket, and then that's kind of our moving target for this measurement of inflation. But if you were to go back and look at the cost of goods index based on how it used to be calculated for CPI and apply it to today's numbers, you get about 14%. And so not only is the S&P, not only is that monetary inflation, but also that cost of goods index based on the original calculation of inflation is around 14% as well, which is, there's coincidences in life, but it seems to keep coming back to somewhere in that kind of mid-teen number when we're trying to understand what is that inflation.
Yeah, isn't it interesting? The hedonic adjustments kill you. But on the other hand, and I say this oftentimes, inflation is a vector, and what I mean is you got to use multi-dimensional arrays and linear algebra to even start n-dimensional linear algebra to even start to deal with the issue. Another way to say it is you can calculate a different inflation rate for any person in any jurisdiction based upon their mix of products, services, and assets they want to acquire. And so common sense says a person that wants to acquire a set of manufactured goods and wants to watch streaming YouTube has a lower inflation rate than someone that wants to buy Picassos. Now, what if you want to be rich? If you want to be rich, your inflation rate is very high because you have to acquire assets. If you want to be middle class, your inflation rate is different. So back to why I did what I did. If you're the CEO of a publicly traded company, your inflation rate is the cost of capital. And the cost of because your shareholders hold you to that cost of capital. If I go to a public investor and I tell them my goal is 2%, and they're saying, well, the S&P is up 14%, then I'm undershooting their goal. Their index is the S&P index, right?
Correct.
So the inflation rate for an investor is the index. Now, of course, different investors have different indexes. If you go back to the strategy, if you're a fixed income investor, you've got like a sovereign, or corporate fixed income rate. You've got the junk bond index, you've got the corporate, investment grade index, you've got the sovereign debt index. You have capital structures in the world that have different indexes. Someone that wants to send their kids to an Ivy League school and wants to have a house in the Hamptons, right? They have a different index. Someone that wants to be obscenely wealthy has a different index, right? So that's why you could have everybody talking past each other and of course, if you keep changing the indexes, the S&P 500 index changes, right? They rebalance it. The PCI, the PCE indexes, they get rebalanced. So the indexes are changing. And if you allow someone else to feed you the index they want you to focus on, well, you can see it right now, right? The official inflation rate in Canada is 4%, but the housing price is up 15%. The official inflation rate in the US is 5%, but the Case-Shiller index is up 27%.
Something big.
Okay, and of course, it all comes down to deciding what you want in life. Now, in the last 12 months, the S&P is up 34%. If you're sitting on $100 billion worth of cash and you put it in the S&P index, you got $34 billion back. You have $134 billion right now. Mm-hmm. If you held it in conventional treasuries, you're short $34 billion. If you convince yourself that the inflation rate was 5%, or if you convince yourself that you could say, look, my treasury index is just the short-dated sovereign debt index. And so as long as I'm beating the 20 basis points, I'm good. And, you know, and by the way, like if I have a bunch of money sitting in a bank, my bankers come to me. I've literally had bankers from the big wirehouses. They came to me when I'm sitting on 100 million or 200 million in cash, and they go, you know, we can get you into one of our money market funds that'll yield 22 basis points, and that's much better than the 9 basis points. And they're selling this to me. There are people in suits that make a lot of money, and they're selling it to me. And you read the prospectus, and the prospectus is they're going to do something, and they're going to charge you a 27 basis point fee to generate 22 basis point yield to you. You're literally...
They're making more money than you are.
You're giving 60% of the yield to someone in a suit that's giving you a service to get you 5 basis points more. But there are people that convince themselves that this is a good idea, right? Mm-hmm. And we come back to that in a second. It's an important truism in the market. Why is it that everybody hasn't bought Bitcoin? Mm-hmm. People ask that, right? All the Bitcoiners wonder, why don't all these investors buy Bitcoin? And the answer is, because there's trillions of dollars of capital locked up in capital structures that are chasing a different index, mm-hmm. right? There's trillions of dollars of money sitting with people that think that inflation is CPI. Mm-hmm. There's trillions of dollars sitting in real estate funds, and they're trying to beat CPI. If I got rents and I'm raising them at the CPI rate and I'm happy with it, there's trillions of dollars invested in fixed income funds where they have to beat the junk bond index or beat the corporate index or beat the sovereign index. And if they beat the sovereign index, if I have $20 billion and all I got to do is beat, you know, the junk bond index or I get paid, then I'm getting paid to invest $20 billion to get 50 basis points more.
What happens to those people? Let's say that inflation isn't 5.1% or 5.4%, wherever it comes in, on a monthly basis now. And we all agree it's something that is higher, but there's disagreement on how much higher. Is it 6% or is it 14% in terms of the actual inflation number? What happens to all the people who are using CPI as the benchmark? Do they just succumb to the inflation over time and continue to lose money until they wake up, or something else?
I think a lot of people have a hybrid situation. Like, for example, let's say I run a real estate trust or I run a real estate company and I have $100 million a year worth of rental income. Mm-hmm. It's capped at CPI. The leases are signed 10 years, 20 years, 30 years duration, 5 years duration, and then you've got all the trade relationships. Like I can't go to the people that rent my building and tell them that the inflation rate's 14%. Right? I mean, would you pay a 14% increase in your rent here? No. So there's a certain inertia in parts of the economy where they're going to move up at CPI, or they're going to be flat, or maybe they can do double CPI. But at the same time, maybe you're the person running that real estate company. You're thinking, well, I'm going to take my cash flows and I'm going to invest them in. Would you invest them in a stock that you thought would go up at CPI? Or would you invest them in the S&P index if you thought you would get CPI? Not really. Yeah. So what you have is you have people that are sweeping their cash flows from an operating business that's low growth, mm-hmm. and they're putting in the S&P index. Mm-hmm. If
they're looking for the growth to come from the investment.
Okay, the S&P is up 34%. How many companies in the world generated 34% more cash flow or raised their prices by 34% or grew their revenues 34% in the last 12 months. Not many, right? Yeah. 98%, 99%, they're in a fiat operating system where they're going to raise their prices or generate cash flows at a rate slower than the rate of monetary inflation. But those same people will turn around and they'll buy Bitcoin, or they'll buy property, or that you may buy property that is going up faster, right? There's not a single commercial rent, there's not a single commercial lease, I think, in the world where they raised the price of the rent 27% in the last 12 months, right? At least I can't imagine if you had a lease, no one's got it capped at the Case-Shiller index. So on one hand, residential property or other types of property could actually be accreting at a much higher rate while your rents don't accrete at a higher rate. So you're taking duration risk. So I guess the more important point is there's a lot of capital. When we think about capital structure, it's like $500 trillion to $900 trillion of capital floating around there. It's locked up in structures. Some of it is in currencies and it can move rapidly. Some of it is invested in companies that can't, right, move rapidly. Some of it is tied up in equity. Some of it is tied up in debt. Some of it's tied up in a trust. I have a trust. My trust gave $10 million to a financial advisor or to a company whose strategy is investing in mid-duration corporate debt. And every year I review their performance versus their index. And over the course of a decade, I might start to shift small amounts out. But I think that the capital is structured in such a way, there's enough inertia in the system that it could take 30 years for the capital to get reallocated. Like we're waging a war on the 60-40 portfolio, right?
Is it dead?
How long will it take before people allocate that as 65-35 or 70-30, right? It takes a long time. There are people still invested in gold. You and I joke about that. Gold's been failing for 12 years or something like that, right? Gold's the same price as it was when Bitcoin was invented, and yet an aggressive move would be a macro investor allocating from 50% gold to 45% gold and 5% Bitcoin, and that's a year's work.
Yeah. Let me ask this question. Retail investors or individuals, I think over the last 12 years or so, took Bitcoin, and as a generalized group, it went from a contrarian idea or contrarian trade to a consensus trade. There's now 100 plus million people around the world that have decided, hey, this is good enough for me to go ahead and store some of my value or economic wealth here. And so you can argue that contrarianism became more of a consensus. We now, over the last maybe 18 months, have seen in the financial or institutional finance world more people jumping into the game. And so definitely some shift from pure contrarianism to now a little bit more of a consensus. Everyone has to have some sort of Bitcoin strategy. You can't simply just say, oh, it's just for drug dealers, it's just for criminals. You at least have to have had a conversation now because Fidelity, Paul Tudor Jones, Stanley Druckenmiller, many others have all now started to participate. What does it take for public companies where I basically break down, there's two groups, right? There's yourself, Tesla, and Square as the three major publicly traded businesses that are multi-billion-dollar companies that have pursued a treasury strategy that includes Bitcoin. And then there are all of the publicly traded crypto native companies, whether they're miners, whether they're places like Coinbase, et cetera. It's still contrarian in the public markets to have Bitcoin on your balance sheet. What does it take to get the shift that we've seen in those other two cohorts to now get it to a consensus type, movement or idea?
I mean, I think there's some, you could check off catalysts that are impediments that will become accelerators. First of all, regulatory clarity, right? If you're seeing support for, let's start with the most basic issue. Is Bitcoin an asset or a currency? Okay, the word cryptocurrency is a very politically charged word because if Bitcoin was a currency, it's in opposition to the US dollar, okay? And if it's an asset, it's in opposition to gold, Okay, so just resolving the fact it's a digital asset, not a digital currency. Most people, how many public speakers, how many well-regarded investors have made negative comments about Bitcoin over the past 12 months because they mistakenly think it's a currency and they think they're sticking up for the dollar, right? Many. Like, I prefer the dollar. So if you understand it's a digital asset, a scarce store of value, speculative digital asset, that's how politically correct people would refer to it, right? And anybody else would say it's just a digital asset or a store of value asset. The first impediment is just understanding that and educating the market that it's a digital asset. I think the second impediment is getting over the issue of is it a threat to the powers that be and will it be banned? So first, what is it? It's an asset. Second, will it be banned? Okay, well, no, we're not going to ban cryptocurrency. We're not going to ban Bitcoin. It's going to be around here. So those two checkboxes are huge. I think the third checkbox is, can I actually buy it via my existing bank? Every publicly traded company has been doing business with probably the same bank for 30 years, Pomp. Some have been doing business with the same bank for 50 years. Some for 100 years, okay? If you trace it. To have adopted a new banking relationship is not a one in a decade thing. But public companies don't change in a decade, right? So if I could buy this directly through Bank of America or JP Morgan or Citigroup, et cetera, I think that makes a big difference. If I have to go to an institutional grade Bitcoin exchange, that's a 1-year exercise in due diligence. Right?
There's friction to doing it.
There's two issues, right? One is before you give $1 billion to a counterparty, you have to inspect their accountants, their legal teams, their licensing, their executive team. Would you give $1 billion to a private company that's new, right? It's like, that's a huge hurdle. And the second is they're not FDIC insured, right? They're not, the imprimatur of being backed by the U.S. government means that, in any liquidity crisis, the Federal Reserve gives you $10 billion or $100 billion. How much money did you need, right? And that's what the big licensed banks have. And, the last holdout that wasn't doing that was Goldman Sachs. In the great financial crisis, they broke down and they became a bank, right? And it matters. So if you want to move huge sums of capital, right, at the point that some of the major banks handle the asset, that makes a big difference because it checks a lot of boxes and people are pretty conservative about that. I think the next hurdle is accounting.
Explain what this problem is, because I don't think a lot of people understand how big of a problem this is.
Yeah. It's a source of massive inertia because every publicly traded company is running on GAAP accounting. And so we're publishing our GAAP balance sheet and our P&L every quarter. And investors are reading the P&L. And the whole point of GAAP accounting is, in theory, I ought to be able to, at a glance in 30 seconds, look at your balance sheet and know how much capital you have. And in 15 seconds, look at your P&L and know whether or not the business is well run. And when the GAAP accounting aligns with the underlying business, then you can do that. But when it gets out of alignment, then you have to adjust it with pro forma accounting, non-GAAP accounting, or adjusted accounting. And when you get to adjusted accounting, it goes from being a 30-second inspection to a 30-minute thing. And you know how difficult it is to communicate a 30-minute concept to the world? Very, very challenging. So the issue right now, and the issue when we got into Bitcoin is no publicly traded company held any material Bitcoin. So the accounting treatment was probably appropriately conservative. The most conservative accounting treatment you could imagine is indefinite intangible. And what indefinite intangible accounting means is you buy something, you test it against the market continually. you take the lowest bid and you mark the value of the asset down to the lowest bid at any point in the history of your ownership. And you treat that not as an investment, but you treat that as a loss in the core business, the operating business. So if you have a business that makes $100 million a year and it's run perfectly, with a perfect pegged 20% operating margin, right? If you buy Bitcoin and Bitcoin trades down for 1 hour and trades back up again, you might have $100 million operating loss. Mm-hmm. And then you would be showing the business made no money this year on a GAAP basis. So now you're an outside investor and you're staring, you're saying, what happened to the software business? It looks like the operation got wrecked. If I made 1 million decisions poorly, I probably couldn't go from 100 million in cash flow to zero, right? Mm-hmm. Or if I did, it'd be challenging. Or on a Saturday night, someone could flash crash something and you would have $100 million loss showing on the operating statement. So indefinite intangible means you take the volatility as an operating loss on your P&L and you take the theoretical worst case. The theoretical worst case would be, I buy Bitcoin and I wait for the lowest price ever and I sell it all. Mm-hmm. Okay. That you take the theoretical worst case and you represent that as the status. So when you print your quarterly results or you print your annual results, you want a simple example. You buy $1 billion of Bitcoin, it trades down to 500 million, then it increases to $1 billion, then it increases by a factor of 10 to 10 billion. If that's the fact pattern, when you close your books under indefinite intangible, your books say you have $500 million of assets and it says that you lost $500 million in the operating business and the money's gone. That's what GAAP accounting says. Mm-hmm. In actuality, you might have a statement that says you have $10 billion of assets and it looks to the casual observer like you generated a $9 billion investment gain. Mm-hmm. So now how do you fix it? Pro forma adjusted accounting. You have to create a schedule, a reconciliation. But now what have you done? You've just made first of all, you've made the investor's job 100 times harder. Mm-hmm. And investors got to read all the pro formas, think about it, and then they've got to reverse it out and figure out what really happened in the rest of the business, right? And then they've got to figure out what's your balance sheet really look like. And then the second problem you have is your statements become non-comparable over time. Like, for example, if I look at my balance sheet on a GAAP basis today versus a year ago, right? Bitcoin could go up by a factor of 100. The balance sheet doesn't change. So when you're comparing quarter versus quarter, there's no information there because you're suppressing it, right? Yeah. And then if two companies have Bitcoin, one company has 100,000 coin and one company has 10,000 coin, and Bitcoin goes up by a factor of 10, neither company shows an investment gain. Neither company shows a balance sheet adjustment. And so how do you compare one company to the other company if you're trying to make a rational investment decision? So things become non-comparable across securities and they become non-comparable across time. And you're invited as an investor to create your own set of pro forma systems to compare it yourself, mm-hmm. which is like 1,000 times harder. So that's an impediment for a public company or for a company that relies upon GAAP accounting. But here's where it's really an impediment. Like, why can MicroStrategy do it? Well, because we rotated our shareholder base to be long Bitcoin, and because, fortunately enough, we were able to build a substantial Bitcoin position. So now, if you know that MicroStrategy has 114,000
Bitcoin.
Yeah, if I have 114,000 Bitcoin and 114,042 Bitcoin, all you have to know about MicroStrategy is take 114,000 and you multiply by the price, and mm-hmm. you know that we've got that much. But let's say that you were Google, mm-hmm. or you were Apple, or you were Facebook. Well, you've got all these other businesses or Amazon, and now you're trying to decompose the businesses. And if they buy a big Bitcoin position, then what looks like a pristine P&L, everybody debates, is Apple's gross margin going to be 38% or 38.5% this quarter? And that's a big deal, right? I mean, there are people who take victory laps on getting within 1% of the gross margin. Well, your gross margins would totally all your margins get blown out of the water from the volatility, the accounting volatility of the Bitcoin. So
how do we solve it? What is the change that needs to be made where you would say, okay, the system we have right now is an issue and it's an impediment. If we move to X, that's the solution in your opinion?
Yeah, well, I joke with people, right? Like, you'd be better off buying baseball cards or art or just about anything than buying Bitcoin from an accounting point of view. Because if I went and bought sculpture or, some random anything, normally the test would be like once a year, you check to see if the asset's been impaired. But checking to see if an asset's impaired occasionally is much better than checking to see if the asset's impaired every minute of the day, right? So there are different types of accounting.